Hello everybody and welcome to today's webinar. Today we're talking about a specialized subject that I really care a lot about and I think you're going to care a lot about as well, and that is using stops to protect our capital. Now you know stops are one of the most valuable tools that we have as a trader, yet ironically a lot of traders ignore the use of stops, and even more traders maybe don't understand the use of the stop, and of course there's a lot of myths surrounding it and everything else. So today we're going to kind of approach some of those subjects and see if we can't bring some clarity to the subject of stops. Here's our agenda for today. We're going to talk about the purpose of a stop. We're going to discuss basic stop orders. We're going to talk about setting a stop with your broker. We're actually going to go into a broker and do it. And then I'm going to show you how you can learn more about setting stops. All right, so let's get started here. As we talk about the purpose of a stop, the purpose of a stop is simply to protect our capital. Let's take a look at this trade here and notice that, this Halliburton trade has been in a bit of a decline, obviously, and then we get to a support level here. And as that support starts to form, well, if you're like most people, you're starting to think to yourself, hey, that'd be a really great place to buy the stock, right? It's hit support, it's come back down a couple times. And so maybe you draw a support line in there and you think to yourself, yeah, this is it. This is my opportunity. This trade's going to be going up. I'm going to buy this thing and maybe we're going to retire on this little Halliburton oil trade. So you buy the stock, and then of course what happens almost, it seems like immediately, the minute you buy the stock, it turns around and it starts going down, and then before you know it, you're crying, you're like, oh, I can't believe I lost all this money, this is horrible, it's the worst thing that's ever happened to me, the stock market's rigged, market makers are chasing me, blah, 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 blah. You know the stories, all right? So that is the danger of buying stock, and that's why we want to use a stop. The purpose of the stop order is to use it as a tool that we can use to limit our losses if and when a trade moves against us. That's really all a stop is. It's a tool that we use to protect our capital. So let's take another look at the exact same situation here. But in this case, let's say we had entered up here where we kind of talked about in that last slide. But if we had a stop in here, what the stop says is the trade can come down to, but not below that stop price point. So the trade can actually fall to that point, but not below it. When we get to that point, the stop order kicks in and it tells your broker, hey, get me out of this trade. I don't want to ride this thing all the way down to, $38 a share. I don't want to go over the cliff with this trade. It goes against me. Now that I know the trade is broken down, I want out of the trade. And so instead of having all this exposure in the trade, what we can do is we can have the computer and the broker automatically place the trade for us, and then it gets us out of the trade, and of course it protects our capital. So that's the purpose of the stop. The purpose of the stop is simply to protect our capital if and when a trade goes bad. And if you've been in the market very long, you certainly know a trade will go bad at some point. All right, so with that as a kind of a framework here of why we use stops, let's talk about the types of stop orders that we've got. There's several basic stop orders. There's really three that pretty much any broker that you're going to deal with in today's modern market is going to have available to you. You've got your basic stop, you've got your stop limit order, and then of course you've got your trailing stop. So let's take a look at each of these so that we can understand better how each of these works. So let's start here with the basic stop order. This is the basic order that we would call a stop. And it simply is really in its most basic form a trigger. A trigger is a type of order that says if you meet this criteria, then trigger this trade. Well, the stop order is basically a trigger. It says if you meet this criteria. And that criteria is, in the world of a stop, going to be if the stock hits X price. So you set the price. If the stock hits X price, then sell my stock, and it's going to trigger a market order. That's what distinguishes a basic stop. It's if the stock hits this price, trigger a market order. And that's going to be a stop order. Now, whenever that order is sent, it's going to be sent to the floor only if the trade has hit that price point. If the trade gets close to it, but it doesn't hit the price point, the order never gets sent to the floor. And contrary to a lot of myths that are out there, the market makers cannot see those orders. That stays on the broker's computer until the price of that stock has actually hit the price of the stop. And then when the stop is hit, it triggers the order and it sends it down to the floor. And then the market makers are going to fill it as a market order. Now, being a market order, it may or may not be filled at the stop price. Understand, a market order says take it to the floor and fill it at the best price possible right now. Well, maybe the difference between the stop price getting triggered and the time that it takes to get that order to the floor, the stock may have slipped a little bit. We call that slippage. And it may have slipped down, 2 cents. It may have gone 20 or 30 or 40 cents. And so it all depends on the liquidity. It depends on how fast the stock is falling. But we call that slippage. And for a lot of people, that's the danger that they don't like about the stop. They say, well, I may not get filled at that price. But that's the basic stop order. Let's take a look over here. And if we were to set that basic stop order on the Halliburton trade. We entered the trade up here, and let's say we set a basic stop at 47.50. What it does is it says when the stock falls down and hits that stop price of 47.50, then trigger the order, and that order is going to be a market order. It's going to be sent to the floor to sell the stock at a market price, and that's your basic stop order. Now let's talk about the stop limit order, and you're going to see the distinction between these two types of orders. A stop limit order is similar to a basic stop, but the difference is it says if the stock hits X price, then sell my stock at a limit order. That's the difference. It's still a stop, it's still a basic trigger that triggers the trade, but the difference is it triggers a limit order as opposed to a basic stock market order. Okay, so it's going to trigger that limit, and now we've got a specified price that we're willing to sell the stock at. So it's going to trigger the order. It says if the stock hits X price, then sell my stock at a limit order. And you need to understand that this order is only going to be sent to the floor if and when the stop price is hit. Same distinction that we have with the stop order, only if it's hit. It's not sitting out there for the market makers to see. They can't go, say, oh, Bobby over here has a stop order sitting over here at 47.50. Let's run over there and trigger that order. No, that's not what the market makers see. All they know is we're trying to make a market, and they get down to a price, and suddenly at 47.50, a new order to sell came in. And if it's a stop limit, then that's going to be a limit order that came to them to close the trade. Now, the stock is only going to be sold at a limit price or better. That's why we call it a stop limit. And if you're familiar with a limit order, it just says, sell my stock at this price or better. Now, the good thing is you're going to sell at that price. The bad thing is you may never get to that price, so the order may never get filled. And this is the risk of using a stop limit order. The risk is that you run the risk of not actually getting out of the trade because you've used a limit order. And so let's say that the stock gaps past your limit order. Well, you're not ever going to get out of that trade. Let's take an example here. Let's look at the same trade. And let's say, we entered the order still at the same place here, but we use a trigger or a stop at 47.50. So when the stock gets down to 47.50, it triggers it. But when it triggers it, it triggers a limit order. So when the stock hits 47.50, it triggers a limit order that is sent to the floor to sell the stock at a limit price of, and then you fill in that limit price. So maybe you say, I want it at a limit price of $47.51. Maybe you say I want it at a limit price of $47.75. Maybe you say you want it at a limit price of $46. Whatever the limit is, that's what you set. But what you're doing is you're saying I will not accept less than the limit. That's why it's called a limit order. Now, the limit order has some great benefits, specifically that obviously it's a stop and it gets you out at a specific price so you can kind of measure your risk better. But let's understand better the danger of the limit order. If you look over here at the screen, let's say, for example, maybe I drew this line a little tall. Maybe the actual stop price is right below that gap, and so when the trade opened, we gapped all the way down here to about $45 a share. Well, yes, it triggers the order because it's a stop that says if the stock is at 47.50 or lower, trigger it. Problem is, what if we triggered a limit order that said I will only accept 47.51 or better? Well, now we've got a problem here because the stock is trading down here at 45. So your broker cannot legally fill that order at 45, even though the stock continues down the mountain and it continues to sell off. The broker cannot sell that trade for you at $45 because you've told them, I will only sell at a limit order of 47.51 or better. That's the danger of the stop limit. Whenever I hear myths about stop orders and people say, oh, stops don't work because the market can gap over it, this is the order that they will gap over because people have set a limit order. They're expecting to get out exactly at that price, and then the stock may move on without them. And unfortunately, that's not going to be a very protective stop in that particular case. But that is the stop limit order. Now let's look at the next type of order, which is your trailing stop. The trailing stop is a very popular order. It has some benefits, but there are some challenges to it as well, so we're going to talk about those right now. What happens with a trailing stop is the stop is automatically trailing up with the increase in the stock price. So as the stock makes a higher high, the stop is adjusted with it. With your initial basic stop, you just set a price and you say, if I drop below this price, then get me out. Well, what happens when your trend is moving along and you're saying, hey, I want to lock in some of those profits? The trailing stop is a mechanism to do that. So let's understand that a little bit better. As the stock hits a new high, the stop price is increased to help lock in some of those profits. And what this is good for is it's a way to lock in the profit so that you can say, you know, hey, maybe during the day the stock ran up $4 or $5 and then it pulled off $2 or $3. Well, you can get out and you can lock in that profit. And that's the functional positive use of using the trailing stop. When it's triggered, what it does is it issues a market order, and you actually want the market order. You would not want a limit order in this case because, frankly, you never know how high that trade may go, so you wouldn't want to limit yourself at whatever price it would be stuck at. So you say, yeah, I want to use a market order here because I just want to get out as fast as I can when that trailing stop is triggered. Let's take a picture here, and let me kind of graphically depict this for you. We've got an entry up here in a bullish trade, and you notice this is the high point of the day. So what we would do is we would say maybe a trail. It looks like I've got about $2 here. So let's say that we've trailed this stop by about $2. As we get into the trade, we set the initial stop. That's about $2 down. But now watch what happens as the trade moves further. Okay, we've made a higher high, and look here, our trailing stop has moved up. Now we have a new stop point. Okay, next day, let's see what happens here. We move the trade further. The stock makes a higher high and the stop trails up higher. Same thing happens the next day. It makes a higher high and the stop trails up higher. The next day we don't make a higher high and the stop basically stays the same price. Now the next day what happens? Made a higher high. The stop is trailed up a little bit higher. The next day we stay at basically the same price. The next day we make a higher high and the stop trails up again, and now the next day, oops, there we go, we get stopped out of the trade. Now as you can look at this, this is a great kind of automatic way to manage your trade, and for that reason a lot of people really like the trailing stop. Let me tell you some of the challenges of the trailing stop, and then you can decide if it's going to work well for you. The thing I don't like about the trailing stop is you're always selling on a downtick. Take a look here and notice what happened. The stock actually traded all the way up to 106, but then we ended up selling it down here below 104. Why? Because we were using a trailing stop. And so maybe the trade went higher. We don't know if the trade was going higher, but what we do know is we lost $2 of profit that we had there. You say, well, you couldn't have known that the trade was reversing. Well, maybe we didn't know exactly, but what we did know is there was a shooting star candlestick, and our basic rules of shooting stars say whenever we see a shooting star, we're going to tighten our stop. So in this trade, we should have just naturally tightened a stop probably up to about 105 or somewhere close to there, so that we could have gotten out a little bit higher there and we would not have had as much of a volatility there. Now that little downtick challenge that I personally don't like about the trailing stop, that causes a lot of people to tighten the trail too much. And then what happens is the intraday volatility of the trade will stop a trade out possibly days or hours before a trade should be done. And so what people will do is they'll say, well, the $2 trail, that's too big. I don't want that much of a downtick. So they may tighten it up to a 50-cent trail. Well, 50 cents isn't enough to allow for intraday volatility. And so what happens is the stock runs up and down maybe $2 for the day. The stop ends up trailing out, so you get out of the trade, and then maybe by the end of the day it's gone on to make a higher high. And then a trader's really frustrated. They say, I can't figure out why my stop got me out of the trade. Well, it got you out of the trade because you set too tight of a trailing stop. And so those are some of the downsides that I don't like about the trailing stop, and it's some of the ways that people misuse it. Now, in fairness, with some of the downsides that I don't like, in fairness, I actually would never use a broker who did not offer a trailing stop, because while it's not my favorite stop to use, there are certain circumstances where maybe I would like to use a trailing stop, and I would be very upset if it wasn't there. It is a great tool. I like to have it available. I just don't think it's the only way that we should use to get out of a trade, and so let's not get too reliant upon that particular type of a stop. So now that we've kind of got a basic understanding of the different types of stops, we got the trailing stop, we got the stop limit, and the basic stop, and we've also got an understanding of why we use stops. What I want to do now is I want to get over and actually get into a broker platform and look at how we can execute this trade, start walking through each of these so you can see how it sets up in an actual broker platform. So I want to start here with my Options House account, and I've already got a trade set up in here. I purchased a couple of shares of the Halliburton stock so that we could do this example. Before you can ever set a stop order, you already have to own the stock. You can't set a stop for a stock that you do not own. So I've already purchased the stock here, and the way that we're going to do this is we're going to select the position. If you look in my positions here, I've got some Halliburton stock. You can see I purchased 100 of them, and we've got a cost basis of $37.86. All right, so let's go ahead and click on that link. And when we click on it, you get a little drop-down menu, and we're going to come down to the icon or the whatever you call that menu item that says Sell Halliburton Stock. Sell Hal. All right, so we're going to sell that. And when we do that, the order form pops up. Now, if we zoom in on the order form, we can read through all this, and we can see that the action is set to sell. And if we look over here at the quantity is 100, and the price type is a limit. Well, we want to change that from limit order. Look at that. There's a stop order. Now, this price becomes a $37.97 stop price. And if we hit the stop price, then it becomes a market order. Okay, so let's preview this and watch what the script says. The script says here, sell Halliburton at the market price with a stop price of $37.97. So what does that mean? It means if Halliburton drops down to $37.97, it will trigger an order to sell the stock at a market order at that price right there. $37.97 will turn into a market order. Okay, so that's how you set your stop. And then we're just going to sit here and click place the order. Now, as I get ready to place the order, you see that the order has been grayed out here. Let's come up here to the order message and notice what we see. In order to sell a stop, the order must be below the current bid price. So I accidentally set this above the bid price. So let's go ahead and go back to revise order. And notice our bid price here is $37.97 by $37.98. Okay, so let's just lower that. Let's say that we'll set this stop if Halliburton drops down below, say, $36.75. Not 336, but 36. Now let's preview that, and you can read that, and it says, okay, sell Halliburton at the market price with a stop price of $36.75. So if we drop down to $36.75, it will trigger a market price. Now you see the order message. You are able to trade with the given parameters, and we hit place order. Okay, now that we've placed the order, notice what happens. It fills down here in the order form, and this is an open status order. You see Halliburton stock, and if we zoom over here to the right side, we see it's a sell to close. If we keep coming over, you see it's a price of $36.75, and it's a stop with a duration of the day, and that trade is still open. Okay, let's walk through a stop limit order, and to do that, I'm going to really quickly here get rid of this this order. We're just going to cancel it, and so we've just canceled that order. So now let's come back to our Halliburton stock, and let's click on Hal stock, and we're going to go sell Hal stock. And again, the order form has been propagated. We're going to sell it. The quantity is 100. The price type, now instead of selecting stop, we're going to select stop limit. And again, the stop limit is going to have two prices. We've got both the stop price and the limit price. So let's set the stop price. We said $36.75, and I just made that number up. And then for the limit, at the time that the stop price becomes active, now the limit order becomes active, and we could do $36.75. That would say we want to sell at the limit price of the exact stop price, or we could make it higher, or we can make it lower. We could do it whichever way we wish to do. So maybe we want to make it a little bit lower. We say, hey, if I get down to $36.75, then sell it for at least $36.60. You know, if it's $36.55 or whatever, we don't sell it yet. But, you know, that's the danger. It's selling off in a sell-off, so oftentimes you may not get filled here. But the idea here is that we're going to set a stop price. That's your trigger. And then the stop limit, the limit price, is the price at which you want it to be filled. Okay, so we got 100 Halliburton stock at the limit price of $36.60 with a stop price of $36.75. Okay, so that means if we hit the stop price of $36.75, that's the stop price, then it will be filled, it will send a limit order of $36.60 to the floor, and we will get filled at $36.60 or better. Okay, it will only get filled at that price or better, and you hit place order, and the order has been placed, and it shows up in your trading account. Okay, so now the final stop that we want to place here in Options House is the trailing stop. So let's take the same trade. We'll take our Halliburton trade, and we're going to click on Sell Halliburton. And notice again, the field has been propagated. We're going to sell it. And if we come over to the right, we want to do a market order. Why a market order? Well, remember, we want this to trail along, and we don't know how high it's going to trail. So we're going to do a market order because when it does stop out, we need to get out at that price, and there's no way to set a limit order based on that. So we're going to set a market order. And the way you set a trailing stop in Options House is just above the order form, you see a little box that says trailing stop. So we're going to click trailing stop, and bingo, there it is. Now let's read our condition. The condition is if the last price of the stock is up, well, we want it down. If the last price of the stock goes down, and then we can do it in dollar or percentages. So let's say if the last price of the stock goes down $1, then trigger my order. Okay, so let's hit our preview, and then we can read this, and we can see if Halliburton has a last price that's down $1, then sell Halliburton stock at the market price for a duration of a day order. And that's how you would set a trailing stop on the exact same trade. By now, you're certainly wondering how you can learn more about setting stops. So let me tell you about a program we've got here at Tradesmart. It's called our Mastery Series. And in the Mastery Series, we actually have a specific 1.5 to 2 hour training on using stops, much more in detail from what I'm talking about right here. This was just kind of a basic overview, but in the Mastery Series, we're going to really dive down into some great detail of setting stops. We've called this program Stop the Madness, how to use stops like a professional trader. And so let me tell you a little bit about it. In the Stop the Madness program, we're going to talk about the philosophy of stops, but more importantly, we're going to get into how to determine where that stop price should actually be. You know, every trade's a little bit different. A stop price for a $10 stock may be totally different than the way you're going to set a stop price for a $350 stock. And so we're going to talk about how you determine where you set that stop price. We're also going to talk about how you adjust that stop during the trade. You know, during the trade, as the trade is progressing in the direction of the trade, you're going to want to adjust the stop to lock in profits and to make sure that you're not leaving yourself too exposed. The very moment you initiate the trade, that should be your maximum exposure. And from that day forward, you should never have a bigger exposure than your initial exposure you have when you initiate the trade. So we're going to talk about adjusting the stop during the trade so you can manage that a little bit better. And then we're going to talk about various stop systems. You know, there's a lot of different ways we can trade with stops. The basic order, the stop limit, the trailing stop, those are some orders, but you know, there's systems for trailing stops as well. There's systems for how we set them and how we manage that. And so we're going to talk about those systems. Some of the systems we're going to look at are the stair stops. We're going to learn about parabolic stops. We're going to learn about buffering your stop. We're going to talk about the trailing stop, how you can use that, and a couple of other additional kind of techniques that I've been working with for several years, and I'm going to share those with you and show you how we can use them in your trades. Now, as I talk about the Mastery Series as a whole, this is a series that we've recently rekindled here at Tradesmart. It was a series that we started back in 2011. It was a very, very popular series, and then we kind of got distracted doing some other stuff, but a lot of students have asked for it. It was a very popular series, and so we've brought it back. And what it is it's a monthly webinar series. Unlike some of our other programs that are a 4-class series or an 8-class series, this is just an ongoing monthly webinar series. And every month we issue a new webinar in the series. And what it does is it gives you more of a mastery look, hence the name, at a specific individual subject. So, you know, you think about becoming a master at something. Masters, they not only have the basic understanding, but they have a more in-depth understanding of the subject at hand. And that's what the Mastery Series is really all about, giving you a more in-depth look. Now, the topics that we're going to talk about, they're very broad. For example, this particular class is on Stop the Madness. But we've got other classes on option strategies. We've got classes on technical indicators. All of them are just going into a more in-depth look of the specified subject. And all of them will help make you a much better trader. As we look at the Mastery Series, all of these sessions are recorded. You can come back and look at them. Sessions that maybe you've missed before, you can come back and watch those online. And then, of course, you can continue joining the live sessions every month. Now, what's great about this series is it's a subscription. So you can come in and you can, join some classes. You can watch a couple. And if at some point you decide, those aren't the classes for me, I don't like the way this is going, you can always cancel it at any time. It's very cost effective, and it's a great way to just continue sharpening your skills and becoming a better master at the trades that you're getting into and perfecting your craft and your art as you become a more progressed trader. So let's talk about the pricing for it. Since we've just recently relaunched this, we're actually offering some early bird pricing. The regular pricing is $89 a month, but right now, as an early bird offer, we're offering this for $39 a month. This is going to disappear very quickly here, but right now you have the opportunity to jump into the Tradesmart Mastery Series for $39 a month. You can cancel that anytime. You're going to get all the live sessions. You're going to get the recorded sessions that are archived there, and all the wonderful things that are included with the Mastery program. So I would love to have you in that Mastery program. It's going to make you a better trader. You're going to understand more about stops, and of course, all things considered, it's just going to make you more money overall. So I look forward to seeing you there. I hope this has been a very educational webinar in terms of understanding stops, and hopefully we'll see you in some more classes.